Stop. Before you invest another dollar, you need to understand this. Because right now, foreign investors are quietly pulling billions of dollars out of market. Not thousands, not billions. It's billions. And when smart money leaves, something big usually follows. So the question is not are they selling? The real question is what do they know that you don't? Stay with me because by the end of this video, you will understand exactly why foreign investors are existing and what it means for your money. What is foreign investors' money? First, let's simplify this. Foreign investors are global institutions, hedge funds, pension funds, asset managers. These are not emotional investors. They don't invest based on hype. They invest based on risk, opportunity, and future expectations. And here is the truth most people don't realize. Foreign investors control a massive portion of global markets. When they buy, markets rise faster. When they sell, markets feel the pressure. So if they are pulling money out right now, you should pay attention because smart money moves first, retail investors moves last, and you don't want to be last. But here is where it gets interesting. Foreign investors don't sell randomly. They sell for specific reasons, and the first reason is something that affect every market in the world: interest rates. If you understand this, you understand everything. So pay close attention. Reason first: high interest rates. When global interest rates rise, risk becomes less attractive. Why? Because investors can now earn safe returns. For example, if US bonds give 5% safe return, why take higher risk than stock or emerging markets? So money flows out of risk and flows into safety. This is called capital rotation. And this is exactly what foreign investors are doing. They are moving money from risky markets to safer assets. This is not panic, this is a strategy. And if you think this doesn't affect you, it does. Because when foreign money leaves, liquidity drops. And when liquidity drops, volatility rises, which mean bigger moves both up and down. So understanding this give you an advantage. Reason second, strong US dollars. Now here is the second reason, the US dollar. When the dollar becomes stronger, foreign investors pull money from other markets. Why? Because currency risk increases. Let me explain simply. If an investor earn 10% in a foreign market but the currency fall 8%, their real profit is only 2%, something even negative. So to protect profits, they move money back into dollar assets. This strengthens the dollar even more and create a cycle. Money attracts money and leaves weakness behind. And this is where most retail investors make a mistake. They think market move based on news, but markets actually move based on money flow. News is reaction, money flow is cause. Always follow the money, not the noise. Reason 3, profit booking. The third reason is simple: profit. Foreign investors buy early and sell when valuations become expensive. They don't fall in love with stocks, they fall in love with returns. When markets rise too fast, they lock profit. This is discipline, not fear. And this is why smart money survives long term. Ask yourself this question: are you investing with strategy or emotion? Because smart money always choose strategy, and that's why they stay ahead. Reason for global uncertainty. The fourth reason is uncertainty: wars, inflation, economic slowdown, politician changes. Foreign investors hate the uncertainty because uncertainty increases risk and risk interests capital. So they reduce exposure, not because markets are weak today, but because they want to protect tomorrow. This is forward thinking, not a reaction. And here is something powerful most people don't understand. Foreign investors don't wait for crashes. They position before crashes. They don't react, they anticipate. That's the difference between smart money and retail money. Reason 5, better opportunities elsewhere. Money always flows to opportunity always. If another country offer better growth, better returns or better stability, money moves there. Money has no loyalty, only logic. This is how global capital works. This is why markets don't move based on patriotism. They move based on opportunity, and investors who understand this will long term. What happens when foreign money leaves? Now the important question: what happens when foreign investors exit? Three things happen. First, market becomes volatile. Second, prices may correct or slow down. Third, retail investors panic. But here is the truth: foreign investors don't live forever. They reposition and they return when opportunity improves. They always do. Because smart money doesn't disappear, it waits and then strikes again. And those who understand this cycle benefit the most. What smart investors do? Smart investors don't panic. They observe, they prepare the position because volatility carries opportunity, not just a risk. This is where wealth is built, not during hype but during uncertainty. Foreign interest living is not the end, it's part of the cycle. Money moves, cycle change, opportunities shift. But one thing remains constant: prepared investors win, unprepared investors react. So the real question is not why foreign investors are leaving, The real question is, will you understand the game or be controlled by it? If you learned something valuable from this video, subscribe because I break down how money really moves. Not hype, not noise, just reality. And remember this, smart money lives quietly, smart investors pay attention.